Guys, so I thought it would be a good idea to actually put it all in practice. Now, this example is a bit challenging, so I thought it would be a good one to go through to solidify what we've already learned, okay? And so with that, I am going to switch to a different application, but if you're following along, this is example number 3, okay? All right, so here we are if you have your handout. So we have this company. I didn't read the directions, but what I can give from it, excuse me, is we are journalizing the following transactions of Lilly Heating and Air Company. Okay. All right. So here we are. So A, let's start with A. So A says we purchased $36,000 of merchandise from Shell Company on account. The terms was 110 net 30. Okay. So in A, our journal entry, remember we are always taking the discount no matter what, right? So to do this journal entry, we're going to do a debit to our inventory. Our assets are increasing, so inventory is a debit. And if we did 36,000 times 99%, or you can do it the other way, you should have come up with $35,640. All right, so that's our debit, $35,640. And then our credit is an accounts payable. It's an IOU. It said in the example that it was on account, right? There we go. All right, so here we are. Let's do B. That was it for that one. So B says we paid the amount, we paid the amount on the invoice within the discounted period. So woohoo to us, let's keep going. All right, so if we paid it within the discount period, we're gonna say an accounts payable in the amount of $35,640. And then my credit is going to be cash that is decreasing because I am paying it out, right? So hopefully this looks all very, you're in line with it. It makes sense to you, okay? So now we're gonna move on to C. All right, C. C says, we discovered that $9,000 of the merchandise purchased in A was defective and returned the items receiving credit, okay? All right, so now we're going to return $9,000. But remember, we have to apply the discount, right? So we have to take that $9,000 of inventory that we purchased, and now we have to apply the discount to that as well, right? Which is 99%. And so that comes out to 89.10, right? So I'm returning it. I've already paid off the, I already paid it. So what I'm gonna do is we're going to do an accounts, a debit to, let's say, accounts payable. Okay, we're going to do a debit to accounts payable, which is the 89.10, and then a credit to inventory. We're giving that inventory back, right, of 89.10. Now, at this point, maybe it may be a good idea to do a T account because now you got stuff going all over the place, but let's just keep in mind that this is currently outstanding, okay? We returned it and all of that good stuff, okay? All right, so now we're moving on to D, all right? So D says we purchased $5,000 of merchandise from Shell Company on account, terms was net 30. So in this particular instance, they didn't give us a discount. Man, they doing us dirty, but they didn't give us any kind of discounts or anything like that. So now we're just purchasing it, right? So the way we're going to do that is we're going to do a debit to inventory in the full amount of $5,000. And then our credit is going to be to accounts payable because it says on account of $5,000. All right, E. E is my problem child. All right. So we received a refund from Shell Company for the return in C, less the purchase in D. All right. So let me back this up a little bit. So don't forget, we returned some stuff and all of this good stuff, right? So they're asking us to journalize us receiving a refund from Shell Company for, basically they're trying to have us evaluate what it looks like for C and D. Now, this is where I said maybe a T account will come into play. I've done this example a time or two, so I know that it's helpful to do a T account. All right, so what I'm gonna put in here is an accounts payable, so debit and credit. So in C, right, we have a debit to accounts payable of 8910. Now, this should spark all kinds of things going on in your mind, because again, usually in accounts payable, it's a liability account and it normally has a credit balance, right? But we have a debit in there, meaning they owe us money, right? Because we returned something. All right, and so then we bought inventory in the amount of $5,000, so that was a credit of $5,000, right? So right now, as it stands, the amount that's currently in this account is $3,000, right? $910. That's what they owe us, right? Because we returned this and then we purchased some more, but it wasn't enough to offset what they owe us. And so now they're asking us to journalize the refund that they're going to give us, all right? So the way we're going to do this is we're going to do a debit to cash, because it's a refund, right? We're going to get our money back. So we're going to do a debit to cash in the amount of $39.10. And our credit is going to go to accounts payable to offset this debit. So our credit is going to be $39.10 here, because we're trying to offset what they owe us. So that accounts payable is going to be $39.10. Okay, it looks super duper weird because it usually is not matched like this. It rarely looks like this, but because we returned something after paying for it, and then they owe us money. So this is how we will record this transaction. So hopefully that makes sense. You guys take a second to work through this example one more time to see how it all plays out. It is a bit confusing. That's why I wanted to go through it. But if you have any questions, please do email me and let me know. Okay.